The stock market is on fire lately, but where's it going for the rest of 2020? In this video, I'm sharing my favorite investing tool to show you how to invest for the rest of the year. We'll dig into some professional level stock market data for the risks and returns in 2020. We're talking stock market investing 2020 today on Let's Talk Money.
Beat debt,
Make money,
make your money work for you.
creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now nation, nothing seems like it can keep the stock market from heading higher, but in my experience as an equity analyst, that's when the risks to your investments are the highest. And it's times like this that it helps to look into the data to give you an idea of those risks and the direction the market's going. So I wanted to use today's video to share one of my favorite resources. I've used this tool since my days as an analyst. It's always helped focus my strategy and it'll help you put together a better stock market forecast. So FactSet puts out this earnings insight download, usually every couple of weeks and more frequently when stock market earnings are being reported. It's a great look into the stocks in the S&P 500, how sales and earnings are coming out, and can really tip you off to any problems in the market. And the most recent report is really easy to find. You just go into Google and type in FactSet Earnings Insight. Now, the most recent report is almost always going to be the first result. It'll be a PDF that you can download a copy or just view online. So I want to scroll through the most recent report and show you what stuck out to me and use that to give you some ideas for the stock market in 2020. Companies are now reporting their earnings for the fourth quarter, so we're getting a crucial look into that holiday period for companies and how it drove profits. Remember that stocks are an ownership in a company's earnings, so this is ultimately what you own when you invest in a stock, and you want to see this number growing. And this highlighted area for the earnings growth rate immediately hit me like a sack of doorknobs. This says that earnings are 1.9% lower over the last year, and companies have been reporting this kind of earnings decline for a full year. So even though the market is booming higher, profits of these companies are shrinking. Now we're not in a recession yet, and the market can still go higher with a little bit of profit weakness, but this is a huge warning sign. And if we scroll down a little bit, FactSet always gives this topic of the week a way to go into a little bit more detail, and this week it's a great look into how expensive stocks are right now. So FactSet shows you the forward price to earnings ratio here. Now, most investors are used to seeing that price to earnings ratio. That's a stock's price divided by the earnings, so a measure of how much investors are paying for each dollar of a company's earnings. But you're usually seeing this on a trailing basis, so the earnings a company has made over the last year. This forward price to earnings ratio, though, is instead taking what analysts expect the companies to earn over the next 4 quarters, so it's a little different measurement. It still shows how expensive a stock or the stock market is, but it's assuming that the analyst's expectations for those market earnings are going to be pretty close. And we see that the stock market is at its most expensive going all the way back to 2002. We have to go back to the tech bubble for a time stocks were more expensive. Now the stock market as a whole, again measured by that S&P 500, is trading for 18.7 times those expected earnings. FactSet also tracks the longer term averages, so we see here that the 10-year average price to earnings is 14.9 times and the 20-year average is 15.5 times. So comparing the current price of stocks, that 18.7 times PE ratio, we find the market about 25% more expensive than those longer term averages. Put another way, stocks would have to fall by more than 20% for them to be considered around their fair value, and I'd argue even maybe down as low as 30% or more to be considered a good deal. So we see in this graph, if we scroll down a little bit, the forward price to earnings ratio for the stock market. And again, this is at its highest since 2002, and I've highlighted this above. Something we'll talk about later, despite the fact that companies are reporting declining earnings, analysts have really high expectations for 2020 earnings. Now, I'm not going to say that my analyst brothers and sisters are full of shit here, but I do think there are some problems here with that forecasting higher profits. So now this next chart, if we scroll down a little bit, shows the PE ratio by stock sector, and you've got some really interesting information here. We just finished up our 13 video series on the best stocks in each sector, and I love taking the data to show us where the best opportunities are in each group. So here we look at the dark blue line is the current PE for each sector against that lighter blue, which is the 20-year average. And you see that some sectors are wildly expensive, like utilities and materials. If you take the current PE of the utilities companies, that 20.5 times earnings, against the longer-term average of 14.4 times, that's 42% more expensive than the sector usually is. On the other hand, we look on the right side of the graph, and some of these sectors like energy, healthcare, and financials are much closer to their long-term PE averages. So using just this chart, you get an idea of how expensive each sector is, and maybe, just maybe, the relatively safer sectors if the market gets into trouble. You've got the sectors that are relatively cheap, so that energy, healthcare, and financials that won't have quite as far to drop in a crash. Then you've got something really interesting here also with this consumer staples sector, which is 21% more expensive than its average, and the utility sector. Now, these two are usually what you would think of as safety stock sectors, right? You would expect utility stocks to do well in a recession or a market crash because revenues and profits for these companies are going to be fairly stable. But, and this is the big but here, if your stocks are already trading at 42% more expensive than they normally are, they've got a long way to fall before they have any semblance of fair value. Now, if we do get into a recession, then interest rates will fall, and some of these utility stocks and staples might still be okay. But there's definitely the risk that these two sectors that most investors are counting on as safety in a crash, that they won't quite be the safety that you're going to expect. So scrolling down a little bit more, and we see the detail into the market earnings for the quarter. And this says that if companies in the S&P 500 report an earnings decrease for the quarter, and it's pretty much guaranteed they will, it'll be the first time the market has had 4 consecutive quarters of profit losses since that 2015 to 2016 period. Now, if you remember, stocks were basically flat for the entire year and a half from beginning 2015 through mid-2016. So when earnings aren't great, stocks don't usually do as well as they have been lately. You know, something else that stuck out to me was this revenue growth number. So sales for companies in the S&P 500 aren't doing that badly, actually, with 2.9% growth expected for the fourth quarter. Now, what's surprising about this, though, is that companies are making more revenue, more sales, but not able to translate that into bottom line profits. That's a big red flag for me. It means either costs are going up, so operating costs are increasing and hitting profitability, or taxes or interest costs are going up. Well, we know taxes and interest costs aren't increasing, so we want to take a closer look at those operating costs, especially the general wages and material costs, to see where the problem is. Now, you'll find a lot of detail on the earnings within each sector throughout the report, and we'll get to those next. But what I want to do first here is scroll down to these market forecast section. And this is, here we see the stock market earnings analysts are expecting for each quarter of the year and all of 2020. So here we see, despite the fact that earnings for companies in the stock market only increased by 0.2% in all of 2019, analysts have some pretty rosy expectations for 2020. For this first quarter, analysts expect companies to report earnings and revenue growth of 4.3%, and this is all on a year-over-year basis, so the first quarter of 2020 versus that same quarter of 2019. Now, if you look at the other quarters, though, analysts expect revenue to increase a little up to a growth of 5.9% in that fourth quarter, but they expect bottom line earnings to just explode higher, as high as 10 and 14% in the third and fourth quarter. In fact, for all of 2020, stock market analysts expect earnings to be 9.5% higher, while revenue grows only by half of that, 5.2% on a year-over-year basis. Now, this is where I have a problem. First, you have to believe that profitability is going to turn around and start increasing. If you've already got revenue growth of 5%, so top line sales, but think that those bottom line earnings are going to grow at 10% higher, then that means companies are going to be able to cut costs or use a greater financial leverage or really boost those share buyback programs. Now, interest rates are low, but most companies are already borrowing as much as they want to, so I don't think they're going to get a whole lot more from leverage. Share buybacks have actually dropped 15% last year and are expected to drop another 5% in 2020. So it doesn't look like that's going to boost the bottom line earnings either. So how do analysts think companies are going to cut costs so much that they increase earnings by twice their sales growth? Now, historically low unemployment means wage pressures are going to be going up, not down. I just don't see this big increase in profitability, and that's a big potential for disappointment in the market. So I want to jump ahead and look at this other chart here, and this is going to show the market earnings actual and expected. And what's interesting here is we see all the actual earnings that companies in the S&P 500 have made since 2010 all the way to 2018, and then the expected earnings for 2019, 2020, and 2021. And we see that companies are expected to report about $162 per share for 2019. pretty much flat from 2018. But then we see that big jump, 9.4% higher to $177 per share in 2020. And this, the S&P 500 is trading at about 33.50 or about 18.9 times these forward earnings. But what if those earnings are only 5% higher? So if the market reports earnings of, say, $170 a share, then we see the market is actually trading for almost 20 times earnings. That's expensive. Now, FactSet also surveys analysts for their stock market price targets over the next year, and we see here expectations for about 35.28 on the S&P 500 by the end of 2020. Now, if we look at where the market is right now at 33.37 already, that only leaves about 5.7% for the gain on the year. Now, analysts can be wrong. Hell, they often are. But basically what this is saying is for all that risk, for as expensive as stocks are already, even if those high earnings expectations come out rainbows and unicorns, those analysts only see about a 6% upside for the year. Another theme I want to point out, and this is something that we've seen develop for much of 2019, is the difference between companies that get most of their sales from inside the United States versus those with more international business. So the green bar here is companies with less than half of their sales in the US, whereas the light blue bar is then companies with more than half their sales domestically here in the States. So this first chart is earnings growth for the fourth quarter, and companies with more international business are expected to see a 4.4% decline in profits. Those with most of their business in the United States, on the other hand, are only expected to see about a 0.5% decline in profits. Now, it's the same picture here for revenue growth. Companies with most of their business outside the United States are expected to book lower sales, down 0.4% compared to last year. Companies with most of their business inside the United States expected to book 4% sales growth on the quarter. So what we've been seeing is because of that sluggish growth internationally, but that stronger economy here in the United States, companies with a domestically focused business have done better. Next here, a chart that really ties in well with what we were talking about earlier, how that declining profitability has meant that even decent sales growth has meant declining earnings. Okay, so this chart shows the net profit margin for the market. So that bottom line profitability, with the dark blue line being the end of year 2019 and the gray being end of year 2018. And we see that most of these sectors are seeing falling profitability. Profitability in the real estate sector was 34% in 2018, but fell to 33.4% last year. Tech stocks actually booked profitability of 22.7% in 2018, but then fell to 21.7% in 2019. In fact, only 3 of the 12 sectors saw their profitability increase last year. Okay, so that's financials, utilities, and materials. So there are a lot of negatives here, or maybe I'd say risks is a better word for it, but just an expensive stock market usually isn't enough to send everything into a crash. You might get a 5 or a 10% sell-off, but it usually isn't a crash catalyst like, say, the Fed raising rates would be. But there is a crash catalyst, and I don't think the market is paying enough attention to this, and it's in that recent coronavirus. Now, granted, this isn't some big global epidemic just yet, but this thing hit China at the worst possible time, just before that Lunar New Year, when everyone who's thinking about traveling and spending money pretty much shut down China for business. Now, the virus is going to knock off at least a few percent off first and probably second quarter economic growth for the world's second largest economy. And while these kind of scares have usually meant a bounce back in later quarters in the past, so like that SARS virus, it could be the tipping point that sends the global economy into a recession this time. We were already seeing a record in loan defaults in China. The shadow banking market is on edge there, and some of you remember that huge drop in Six Flags last quarter when they announced that the Chinese manager had defaulted on its loan. So what I'm worried about is that these very rough 2 quarters for the Chinese economy become the catalyst for a financial crisis in the country and just a domino effect all over the world. Now, I wanted this to be more of a resource video, show you the information and let you decide your own stock market forecast for 2020 and then how you wanted to play it. But I can show you how I'm playing these risks and trying to make money as well as protect myself for the rest of the year. First is I'm holding a lot of cash, bonds, and real estate. Normally, I'd have maybe 5% of my money in cash, 15% in bonds, and 20 or 25% in real estate. Right now, though, I've got 25% of my investable assets in cash, 20% in bonds, and 20% in real estate. So about 2/3 of my assets outside the stock market. And we're seeing this a lot in those hedge funds and private equity funds right now. Warren Buffett's Berkshire Hathaway is sitting on $128 billion in uninvested cash. TIAA-CREF is one of the largest pension funds in the US, sitting on 30% of cash right now. Second is I've also sold covered call options on a lot of my stock positions. Now, those of you in the nation are going to remember our options investing video a couple of months ago where I put $25,000 in shares of Uber and Pinterest. But to hedge the risk in those, I also sold call options at a higher price, so I collected some cash on that investment. Now check out that video, I'll link to it in the description below, but those covered calls can be a great way of lowering your risk from a market sell-off while still holding some of your favorite stocks. Third here, I'm also positioned in some of those relatively less expensive sectors like energy, healthcare, and financials. Now that's not to say that these three sectors won't get hit in a stock market crash, but since they're already fairly cheap, they don't have as far to fall and might do a little bit better than the rest of the market. Click on the video to the right to see how I pick stocks. We looked at the entire market in this video. Now get my 10-step process to find individual stocks for the best investments. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.